Welcome back, traders. This week, gold, oil, and USDJPY will be at the mercy of another Middle East drama after weekend drone strikes by the US, Israel, and the UK against Iran. Tensions are soaring, and with Iranian leadership into question following the death of the Iranian supreme leader and President Trump willing to keep fighting as long as necessary, probably safe haven demand will remain elevated, keeping support under precious metals such as gold and of course the US dollar. And the week isn't over. The US Nonfarm payrolls will drop this Friday, providing extra evidence about whether US rate cuts are necessary. So let's dive into the charts as the chaos continues in global markets and see where the storm could take us next. So looking first at WTI crude oil, we can see that the price opened with a huge positive gap near an 8-month high of 75.809 earlier today. It lost momentum following that spike, but obviously Middle East crisis will keep supporting oil prices as further attacks are expected throughout the week. What's more important is that Iran has blocked the Strait of Hormuz, where 20% of global trades are passing through this route. So that is creating extra concerns about deflation and perhaps shortages of products if that closure is prolonged. So overall, the risk is to the upside for oil prices, and once we close above the 73.20 region, where the 23.6% Fibonacci retracement level of this downfall over here from 2022 to 2025 is placed, then I expect further another extension, a more aggressive one, probably towards the 79.50 and 80.50 region. Now the downside, if the price stays below 73.20, perhaps it could find support, or at least it could keep facing support near the 69.50 region, which coincides with another key resistance trend line taking out from February 2024 near 69.50. If that fails to hold, then the decline could stretch towards the 67.35 and even probably towards this short-term ascending trend line seen near 65, where the 20-day moving average is placed. But overall was still far above these support levels, and perhaps Middle East tensions will keep positive pressure on prices. And looking at the technical indicators, we can say that although the RSI is above 50, the stochastic oscillator has yet to peak in the overbought zone. So that is another sign that perhaps positive pressures could stay, especially as the 20-day moving average is rising above the 200-day moving average, that for the first time since July. Now looking at gold, well, the precious metal has obviously gained from all this geopolitical conflict in the Middle East. It moved straight up to 5420. That's where the price faced resistance back in January. It's very close to the all-time high of 5597, and the question is whether we will reach that point again. And given the positive signals down here, it seems that the precious metal may keep gaining momentum, and once it surpassed the 5600 level, then the next target could be the 5950 and 6000 round level, where this tentative resistance line connecting the highs from 2025 and 2026 is placed. Now, in the event of a pullback, I would be quite concerned. It wouldn't be huge. It wouldn't create big concerns, because the price remains supported above the 5090 and perhaps above the 5140, which acted as support as well. There is a key ascending trend line passing through this region. The 20-day moving average is also there, so that creates those lines could cement that floor over here. If not, then perhaps the 5000 level could provide a layer of safety before all the attention turns to the 4855 and the level and the 50-day moving average, where the price bounced up in mid-February. Then lower than that, the 4685 zone, and the floor at from early February could be the next target. And finally, looking at USDJPY, the US dollar also gained from all this geopolitical noise in the Middle East. The dollar strengthened towards the 157.50. That's a key resistance territory. It coincides with a long-term ascending trend line, and that zone is also considered. It also causes some caution as Japanese officials tend to resume their FX intervention talk near these levels. So negative risks haven't actually faded in this market, but from a technical perspective, the RSI and the MACD, as well as the stochastics, are keeping the short-term bias skewed to the upside. So once we overcome the 157.50 level, I expect an extension towards the 158.40 and even towards the towards January's highs near 159.40. But don't forget that we also have the US Nonfarm payrolls report later this week. The data could provide some extra evidence about whether the Fed could continue with rate cuts in the coming months. While forecasts suggest an increase in employment of around 55,000, that's half of January's 130 increase. But the unemployment rate could stay steady around 4.3%. Wage growth could also remain stable near 3.7%. So if that proves to be the case, perhaps some weakness could emerge, but overall, the decline could be moderate unless we see single digits declines in employment, and even a negative revision in previous employment numbers, which could suggest that the labor market is still not out of the woods. So looking for support levels in USDJPY, if non-farm payrolls data arrive weaker than expected, perhaps the price could pull lower, and violation near the 156.30 support territory could take us down to the 20-day moving average near 155.12, while the 23.6% Fibonacci mark and previous lows around this territory could also support the market before a more aggressive decline takes place towards January's and February's lows near 152. The 38.2% Fibonacci mark is within this region as well, and there is another long-term ascending trend line, so that increases the risk of some consolidation within the 151.30, 152 territory, and before we reach the 200-day moving average, currently seen near 151. So that's everything I wanted to share with you guys. Keep a close eye on the geopolitical headlines later this week, which could support safe haven metals as well as the US dollar. And by the end of this week, don't forget to look at US non-farm payrolls. It might be another interesting week for global markets. So wish you have a great trading day, and see you next time. Bye bye for now.